capital market regulator SEBI has raised questions over a popular trend in the debt markets whereby loans are restructured by AIFs or alternate investment funds set up by private equity firms along with NBFCs. Now listen, SEBI is accusing PEs of getting away with a very sweet deal. Now let's go with an example that will make it clear. Suppose an NBFC lends, say, 500 crore to a builder and the builder is under stress due to COVID or whatever. He wants interest payments pushed back. Basically, he wants the loan restructured. The NBFC doesn't want NPA or stress on its books. It goes to a PE. The PE sets up an alternate investment fund in which the PE puts in, say, 700 crore and the NBFC puts in 300 crore. With this, the new AIF loan, the builder is able to repay the NBFC. In the new loan from AIF, the PE ensures that he is the senior partner and the NBFC, which has contributed lesser money, is the junior partner. So when the builder repays the money, the PE gets first charge. The NBFC gets the money only after the PE is paid. Now, SEBI's point appears to be that the sponsor of the AIF has to take the bigger risk. But in the current trend in this product, the PE is the sponsor, but it is taking a lower hit. Not kosher, SEBI appears to say. They are calling it probably a mispricing of risk. NBFCs and private equity entities are upset since restructuring through this route may stop. I mean, both of them are finding it useful. To check out what may be the consequence of this trend getting stopped, we have with us Srini Srinivasan, the Managing Director, Kotak Investment Advisors, among the biggest AIFs in the country, homegrown AIFs. Anant Narayan, Professor of Finance at SPJ AIMR. And in a bit, we are going to get Umesh Revankar as well. But let me start with Srini and Anant first. Srini, your thoughts. I mean, do you think the NBFC is getting greater risk and that is what SEBI is worried about?
I don't think so. I just want to make one correction to the example that you just gave, Lata. Yeah. I think the example that you gave assumes that the entire outstanding of the NBFC is fully repaid by the borrower with the capital that is received from the NBFCs. To the extent that I am aware of, in most cases, the NBFC does not get paid in full. Let's say in the example that you gave, if the NBFC's original loan was 500 crores, they would have probably got maybe 250 or 300 crores, and the balance 250 is their junior participation in the AIF. Having said that, so this has helped a couple of things. Number one, it's been able to resolve a number of very difficult issues, particularly in the real estate sector. And as you know, that the only other alternative during COVID and other cases is for the either the homeowners or the lenders to take the real estate project to IBC. And we all know that nearly 80% or 90% of the cases that has gone to IBC in real estate has not been able to see the light of day, either for the homeowners or for the lenders. So this is a very elegant solution. And most importantly, it is important to understand that subscribers to an AIF, be that an NBFC or other investors, are sophisticated investors. They know what they are doing, whether somebody is participating in the senior portion of the risk or junior portion of the risk. Is buyer beware, and buyer is a sophisticated investor investing very significant sums of money. And this is not very different from how, let's say, loans are sold by banks and other NBFCs when they either anticipate trouble or they are already marked out. So if there is any question, and I just want to clarify that the regulator is aware that this could be an issue. They have raised it, but they are engaging with the stakeholders. And I'm sure as the stakeholders provide their side of the story, there will be appropriate measures that will be taken by the regulators. But I just want to add one more point on this.
Exactly what has SEBI said? What was the phrasing of their question?
Well, it's all hearsay right now and whatever has appeared in the press otherwise. In general, the concern seems to be that this is enabling NBFCs to kick the can down the road. Yes. But, the important point I want to make here is that there is a collateral damage to not permitting this senior-junior structure, which is the bond markets in India. There are many managers who take capital from investors and invest in a series of bonds, some low risk, some high risk, including SME bonds and high yield bonds.
Yes.
Particularly after the Franklin Templeton fiasco, much of the liquidity in these bonds have come from AIFs. Now, if you don't permit investors to take the conscious risk of either being higher up in the risk capital or lower up in the risk capital, liquidity for these kind of bonds and bond managers will suffer. I think the regulator is aware of this. So there is a constructive engagement as we speak today.
Okay, no, I take your point. I mean, I don't think SEBI will want to kill the goose itself. But I'm a little not entirely with you when you say that, it is buyer beware and these are sophisticated investors. We heard all this even before the GFC. So sophisticated investors do, when they have the chance to kick the can down, take risky decisions or decisions not commensurate with the risk. But Umesh Revankar, your call on this entire episode, do NBFCs, do only builder loans go into this kind of structures? Do other loans like your lend also go into such structures?
Yeah, thank you. See, we are into retail lending. In the retail lending, we don't see any kind of a scope and opportunity for such kind of a deal. Here in the large deal, especially what we call as a wholesale ticket, where the real estate lending is involved, the specialist investor or the specialist private equity coming in helps. They not only have deep pockets, they also have a knowledge, because many of them have international exposure and they come with a particular knowledge to deal with such loan exposure. And many of these loans, what I feel is in India, we forced to lend at lower tenor because this real estate requires a longer period loan.
Agreed.
But we are forced to lend in a shorter tenor. So maybe giving some kind of a opportunity to look into this separately does help, is what I feel.
I take your point.
Mainly to resolve rather than just liquidate. And we don't also have enough ARCs which understand the business deeply.
Take your point. Take your point that there is a case for AIFs to step in because they will provide longer term finance, in a sense, even a bit of takeout. Anand, now you're a neutral party over here. What's your sense? This seems to be serving a purpose both in terms of tenor, as Umesh Revankar says, and as Srini says, in getting funds into restructuring a loan, which is also a very useful exercise. What's the problem?
So, Lata, as Srini said, right now we are reacting to hearsay. We don't really know what's going on between SEBI and the industry. But let me take a broader picture out here. I don't think anybody can dispute that where a business goes into some kind of short-term trouble, getting fresh investors, doing some kind of restructuring is absolutely kosher and required. No questions asked. I think characterizing that regulators don't want that to happen in some way is simply wrong. I can't imagine any stakeholder having a problem with any kind of restructuring. I think the broader problem, however, is when a restructuring happens or when a fresh refinancing happens, is there proper valuation of the original exposure? And is there proper disclosure around what this means to the original exposures? I think this is where the question marks arise. And frankly, when it comes to provisioning against restructuring and stressed assets, our financial services ecosystem has a long way to go. I think the fear in something like this, a junior-senior tranche, is there a possibility that the original lender somehow manages to understate the extent of the possible loss on the restructure by virtue of this particular mechanism? Generically, Lata, our own provisions required are somehow seem to be mandated by RBI. For a secured structure, you have 15% requirement up to 1 year, 40% up to 4 years, and only after 4 years you go to 100%. Now, all that is supposed to be a guideline. Now, business people know what the possible, most likely, worst case, best case recovery from a stressed asset is. That is not captured necessarily. You go by what the regulations say, and then you say you've disclosed everything. So I think the point is, yes, restructuring is required, but are we disclosing the risks to valuation adequately to all stakeholders so that we don't end up kicking the can down the road?
No, that's the point. Here it is not the loan that we speak about, 15% in the first year, second year, 30%, fourth year, 40%. Here we are speaking of a debenture. It is more like a security receipt, I would think. So, Srini, that is the point. How is the provisioning done? If the builder is floating debentures and the AIF is buying it, then are the NBFCs marking their debentures at a lower mark to market than the PE? Because clearly their receipt is going to fetch less. It has, it is a junior. So is the MTM proper?
First of all, insofar as the books of the NBFC is concerned, what is going to be reflected is the investment in the junior tranche of units of the AIF.
Yes.
Can the AIF get those units rated? Of course they can. And they can certainly provide that rating to the NBFCs. Should the NBFC, as Anand has suggested, have a greater onus in terms of either disclosure or provisioning? I'm sure, NBFC's regulator, RBI, will have a look at it and they may have a say in this matter. Just like you suggested that in case of a security receipt, there are provisioning norms already provided for in the present guidelines. The similar kind of thing can be extended to such a participation by an NBFC in a junior tranche of units, particularly where the units are rated.
Yeah. So wait 1 minute. That means you admit that at the moment, if the loan had remained with the NBFC, they would have had to show a higher ECL, an expected credit loss. But because now the exposure is not to the builder, but to the AIF, they are not showing that ECL, correct? So they are underproviding.
Yes.
They are underproviding.
It's quite possible. Yeah, it's quite possible.
Yeah. Therefore, Mr. Revankar, RBI not awake? Only SEBI is asking questions?
I think RBI also must be aware of this because these are all in the public, knowledge. I don't think these are all done in a particular deal manner. So I think RBI must be aware. And I think as the industry matures, they will find a solution how to really present it or how to make additional provision if required on such investment. So I think we need to allow some kind of a maturity into the market and market will play its role is what I feel.
Yeah, it's possible, but sometimes markets may get ahead of themselves. It's quite possible that the whole thing will play out very well because we may be at the start of a real estate cycle improvement. And if anything, the AIFs taking the bet at a very good time. So NBFCs may not be left with lemons. I mean, it's quite possible. But Anand, what do you think should be the solution? Should the solution be what Srini is saying? That the AIFs be asked to get a rating and the rating should be different for the two debentures, the senior and the junior. Would that be the solution?
So Lata, extending what Srini is saying, I think the kind of solution required is that we get a realistic valuation of all kinds of instruments, whether they are loans, whether they are restructured loans, or whether they are securitized SRs, which have been bought back by the investor. And the reality is the ecosystem today relies a lot on prescriptive regulations, which prescribe that for so-and-so type of loan, you shall provide so-and-so kind of provisions, without taking into account what the business assessment of the recoverability of a loan is. There is a level of subterfuge involved in not being truthful about what the possible loss on an exposure could be. I think that's where the regulatory discomfort comes. And every time you undertake a structure which does not come clean in terms of valuations and disclosures, I think the possibility that we are building up a set of risks in the ecosystem as we did 10 years ago by doing restructuring S4As and 525s, etc., and kicking the can down the road until it became too big to kind of manage, that possibility remains. I think that entire ecosystem of valuing risks appropriately should be relooked at. By the way, businesses know what those risks are. To say that, we don't know because valuation is a gray area is rubbish. Businesses know what the best case recovery is, what the worst case is, what the most optimistic case is. Starting from there and then on to the valuation agencies, on to the boards, there should be an onus on them to ensure valuation and disclosure is appropriate.
Yeah. Srini, out of time, but just a final question. It doesn't look like SEBI or RBI would want to kill the structure. But if they start putting in some kind of conditions in terms of the senior partner, which is the PE, has to take the first loss guarantee or something, you think the structure itself will collapse?
I don't think so. Look, you see, first loss guarantee may be one of the options, but the reality is that the industry is already engaged in trying to provide the right framework, including checks and balances in very many forms, to make sure that the regulators are comfortable with what we are doing. Most importantly, as Anand mentioned, it's not very different from the security receipt structure, where there is significant upfront cash that is actually paid by the AIF to the NBFC in case there is an NBFC on the other side. Okay. And the other aspect of it is that, I don't think the regulator today is likely to collapse the structure, because it provides a very significant opportunity for the deepening of the lesser heralded bonds in the market. So I think we will have the right checks and balances, and we will make sure that the regulators are comfortable with whatever the checks and balances that they believe ought to be the case, and including whatever provisioning norms or disclosure norms that may be prescribed by, let's say, RBI, for example.
Okay. Well, I guess the two regulators could be talking, and we would hear what their desire in terms of a solution is, probably rating of the two separately, or the PE investor giving a first loss guarantee could be solutions. We don't know. But it's important that the regulators are aware of it. And I think the bigger positive is that perhaps the real estate sector itself is in an upcycle, and we may not be landed with too many unfortunate loans or, bad loans because of this product. Umesh Revankar, Srini Srinivasan, Anant Narayan, thank you very much for joining me. We wrap